Right, g'day there everybody. Thanks a lot for joining me on this Tuesday evening market recap. It has been a little bit of time since my last public YouTube update. It was actually on this particular candlestick here. And really what we were talking about leading into, of course, this sell-off was the potential and also the likelihood that the markets were going to essentially trap a lot of overly aggressive shorts as the market appeared to, of course, break below that of structural support. Now, again, what we were speaking about in terms of adding to our at least existing positions on the indexes, in terms of accumulation prior to, of course, the all-time breakout, was that we were talking about keeping insurance policies on, of course, the rejection of this short side, or what appeared to be that of a breakdown, a technical breakdown, and of course taking advantage and buying strategically into the face again of the continuation of the rising macro, intermediate, and also minor level of the trend, not only applicable to the Dow Jones Industrial Average, but also the S&P, the Nasdaq, the transports, and the Russell 2000. Okay, what we've seen since that YouTube update, taking us back to Wednesday last week, is again the continued acceleration to the upside, which has taken us through to the beginning of trade this week. And I'm going to break down just what is occurring as at Monday and also today. But also, I just wanted to remind you that there is that very powerful, intricate class that we do each and every Saturday, whereby we recap, obviously, what has taken place over the past 5 sessions or the past week's worth of trade. But more importantly, we look at what to expect moving forward into the upcoming week and also upcoming weeks and months. Now, going back into the immediate technical snapshot, this is the chart of the Dow Jones Industrial Average. Again, we got a very strong rejection and an acceleration off from, that fake breakdown, which has probably caught a lot of people, on the short side, or at least unfortunately for a lot of people, they may have actually liquidated some existing longs. And now collectively, either they're buying to cover or they're sitting on the sidelines and they're saying to themselves, well, am I going to dip my feet in the water? Am I going to actually begin buying the markets again after most recently, unfortunately for them, selling out of potentially a lot of positions that they may have actually enacted at some time, really since February of 2019, this calendar year. The good news, however, again, with these insurance policies is that we continue to accumulate these positions prior to the breakout and the continuation of the trend to new all-time highs. Now, what we've seen, Monday and Tuesday, is that first slowdown that we have been expecting. And the reason I say that, very simply, if I was to draw sort of an analog clock on my screen, if we were to sort of show you the angle of ascent, the trajectory of this move higher, we're probably moving towards where that number 1 would be located on the actual clock face. And really why I do this is to show you, to sort of keep things as clean and as clear and as simple as possible, is just to suggest that this type of move that we found ourselves in, off from the first trading session, in the month of June, is that this is unsustainable. And generally what will happen is we'll get some sort of, obviously bearish candlesticks. We'll get some candlesticks suggesting a slowdown, but it's not meant, or at least it should not be interpreted as any cause for concern. And what I mean by that is if we just zoom on out a little bit, and again, we spoke about this over the weekend in the Pro Analysis class, which is up on the website, is that we may very well have a trend line which is now working in conjunction. This is more so the intermediate continuation off from that of the macro primary trend line since 2009. And what I mean by that is if we just have a look at the low in June, that essentially what we've sort of leveled this off, or at least angled this off, and now project this into the future, if we were to see a little bit of a pullback in the markets, which makes a lot of sense given, of course, the angle of ascent that we have been in for the majority of June, it makes a lot of sense that anywhere above, this diagonal sort of trend line just here is going to be met with fierce support. And again, we're sort of being a little bit creative here, whereby we are assuming, based on where the reversal took place at the first session of June, that if we were to see a retracement, we don't necessarily have to come all the way back down to, say, 25,000 or somewhere between 25 and 25,250. But this is a very logical area, as to where we could see these markets retrace. And in that Pro Analysis class, we went into detail as to why that may be, a general vicinity as to where, more importantly, or more specifically, the Nasdaq may reverse into. Very quickly, the answer to that is if you have a look at some of these big tech companies, they do have pronounced gaps that have occurred either between the first and second or the second and third session in the month of June. And what that means is essentially these gaps should close over time. They don't necessarily have to, but if you think about the parallels between a lot of these tech leaders, right, historically speaking, and the NASDAQ itself, again, going in that very, very strong angle of ascent, again, angling up towards the number one on the clock face, makes a lot of sense that we could see, again, the NASDAQ even sell off back into this primary bullish trend line, or not essentially the primary bullish trend line, but I for intermediate trend off from the macro primary trend. And it gives us a general vicinity that we could come back all the way to 7,500 very simply without becoming concerned whatsoever in the state or for the health of the financial markets in the month of June. What we've seen also is on Monday, we have a shooting star candlestick. This is on the NASDAQ, followed by that of just an ordinary sort of bearish inside day candle. If you have a look at the Dow Jones Industrial Average, again, you've got a shooting star candlestick. The real body of this is dark, followed by almost an outside day engulfing candlestick. When I go to the S&P 500, again, this looks more so like a gravestone doji. However, again, it's blended between that and that of a shooting star, mixed with almost an outside day reversal type of candlestick. So we've got the warning signals here. We proposed anyway over the weekend that we could set up some form of a bull flag. All right, so if I were to draw this, that would be the retracement, the controlled retracement. That would inevitably sort of lead to that of a continuation and a breakout to higher prices. But at the moment, right, a lot of the actual profits have already been made in this move, right? Above 25,465 for on the S&P 500, above 2,831. And on the NASDAQ, just above 7,773. We have been, of course, jumping into market positions as the markets have continued to move on up higher. And over time, this market is going to reward people who are, again, disciplined and also patient and understand just simply what's going on below the surface. This is nothing more than a major consolidation. It's nothing more than that of an accumulation prior to a breakout to new all-time highs. A lot of people, unfortunately, market pundits, are calling this some form of a distribution, a market top. And I still very firmly, respectfully, politely, strongly disagree with that assumption. Okay, there's nothing in the technical picture nor the sort of the macro fundamental backdrop, right, that leads us to believe that we are establishing that of a rolling peak at the moment. We're going through the ebbs and flows of a consolidation that has been in effect since the very beginning of 2018. And here we are, almost at the midpoint of 2019. And if you think about it, we're getting towards the sort of the apex of this ascending triangle. And again, roughly, if you're thinking about ascending triangles, roughly 60% of the time, ascending triangles, that's a horrible illustration of writing, my apologies. 60% of the time, ascending triangles will break to the upside. So again, the writing's on the wall. For the bears out there who are still trying to short this market, it's probably becoming more and more painful for you. Again, this market is primed for a breakout. And those who continue to accumulate positions when everyone else is fearful, and again, this goes back to the discussion that we had 2 weeks ago in that recorded class where I wanted to put, of course, any fears or concerns at rest or on ice. And again, prepare you for the continued accumulation of these market positions prior to the breakout. We're already doing exceptionally well in a bunch of trades. But I just want you to be mindful, okay? Even if you got into Apple, for instance, at 184.61, we've spoken about this gap closing, but it's still a fantastic trade up to 215. This has already made $10 of intrinsic value. That's meant to be a percent. Oh, let's just do $10 here. From 184.61 up to 194.81. Very quick move on Apple. Our entire sort of thesis on this was to stalk the trade as the markets continued to retrace. And what I mean by that, we started with the bull entry up here, then we moved it down, then we moved it down, and then we moved it down, right? And as the markets reversed and continued in their bullish trend, we jumped in at 184.61. The same is true for a lot of individual companies. Here's the stock of Amazon, okay? 1828.10. We're trading at 1863.70. But we still have a bunch of these open windows. So again, think back to the market analysis that I just went through with you, the very brief market analysis. Understand that some of these gaps may very well close, all right, or to a lesser extent on the S&P 500, but on the NASDAQ certainly, and how a lot of these individual companies have got gaps that should close prior to the continuation higher. Something to think about. No trade there on Boeing Airlines, no trade on Baidu at the moment. Caterpillar is trying to take on off. It looks like it's doing that of a rounding bottom, so we'll keep an eye on that. ConocoPhillips is pulling back a little bit off from this 60 handle, but we are in that critical sweet spot. 60.79 is still a great entry. We've got an outside day candle on CVX at 122.47. I think this is going to sort of pay us off We're just going to have to be a little bit patient on that trade. We've got Disney, which is still very firmly in a bullish trend. We do have 2 bearish candlesticks at the moment. That is more so, of course, working in conjunction with the reversal signals that we've seen on the market indices. But overall, I am a very big fan of this trade. This has got me very excited. This Disney trade, once we see the markets continue and we see Disney break above 140.283, that's going to be, I think, a phenomenal trade. We've got Google, as you can see just here, the breakout entry, or at least the reversal to close the gap was at 182.90. We close that gap. We've got that bearish candlestick. We might just see a little bit of volatility here, but at least we have a vested interest in that trade. We've got IBM again, taking off to the upside, 132.40. That's a bullish trade as we stalked on the way down, all right, as the markets went into their correction. We're very firmly out of that and above 135.22. And Netflix is still struggling to break out above 366. We've come up very close to this on 4 occasions now, 1, 2, 3, and 4. Sooner rather than later, very similar to that of, not Boeing Airlines, pardon me, very similar to Disney, all right, we're going to see follow through. And pay attention to the CCI and also the ADX. The ADX is reset after the trend and the CCI spike. The CCI is still back down just below 80. But there's a lot of opportunity on these stocks. But more importantly, what we've been speaking about is the environment around us in the markets and how it hasn't been conducive for trend trading. But what people have seemed to forget is just how profitable, obviously, following the trend is when a market index is actually trending. And just a reminder to everyone, if you found it hard to navigate these financial markets over the past, really 1.5 years now, it's because we're not trending. We're in a range-bound market between resistance and also a series of rising supports, okay? What was over here, down to a lower low, but now into a series of what appears to be, again, of higher lows. So once this range breaks, and I'm assuming it's going to be this resistance, once the markets formally confirm one another and move into that of a trending state, it's going to trickle on into a bunch of these individual positions. That's why, again, we continue to accumulate market, or at least longer term market positions, whereby we don't let the sort of the day-to-day sort of immediate price movements affect us all that much. We look for bargains when the markets pull on back. And then, of course, we accumulate and take advantage of it when the markets rise. Okay, in a nutshell, I would encourage you to have a look into that pro analysis class in the meantime. Other than that, that's going to do us as at this Tuesday afternoon market recap. I hope I haven't just been sort of running off on a tangent there. But I mean, anyway, just trying to recap the markets, the first 2 days of the market for this week. Be prepared for a pullback, but do not lose your mind if it does occur. Consider it that of another opportunity to buy the market or buy some of those shares that we've spoken about over the weekend at a discount. Okay, all the best, everyone. James signing off on behalf of Pivot Point Trading. Goodbye.